Good afternoon, everyone, and welcome to our Lenders Roundtable. This should be a good one. And not just because we have over 400 people signed up for this, which I think alone says something, but it's because we have a real star-studded panel of active lenders and experts from every corner of the financing world. And they're all dealing in a very competitive environment with changing pricing, terms. There's a seemingly insatiable demand for acquisitions and refinances in the senior care world. So today we'll get a great snapshot of how deals are getting done right now and all the options that are available to borrowers in a variety of different scenarios. Also today's webinar is sponsored by Blueprint, founded in 2013 with a mission to elevate healthcare real estate advisory through collaboration and data. Today, Blueprint is the most active advisory firm in seniors housing and skilled nursing, and a market leader within other healthcare real estate subsegments like behavioral healthcare and medical properties. The firm also offers dedicated capital markets support to offer its clients a full spectrum of comprehensive debt and equity solutions. And the leader of those capital markets efforts is Blueprint's Kristen Ahrens, who really took the lead in assembling this fantastic panel today. So thank you, Kristen, for that. You joined the firm in 2024, and its capital markets platform has really hit its stride. You have experience also in private equity and the debt side in the seniors housing industry. You also have your ear to the ground on the ever-shifting lending environment. So thank you for being here today, Kristen.
Absolutely, my pleasure. Thanks for having me, Ben.
It's our pleasure. And next, Charlie Shoup joins us from KeyBank, where he's been since 1991, and he's overseen the transformation of its healthcare group from a regional platform in 1994 to one of the most active national lending platforms today. He does it all from balance sheet loans to permanent agency financings, and I'm very glad to have you on today. Welcome, Charlie.
Thanks for having me again, Ben. Appreciate it. Look forward to it.
Absolutely. And also welcome to Shana Weiss, who is a vice president at Bloomfield Capital and will be representing the private credit world today. Prior to Bloomfield, she was a director at the PE firm Valstone Partners and focused on opportunistic and distressed investments. Shana, I'm really looking forward to hearing your perspective today. Thank you for joining us.
Thank you.
And Karina Davidoff is here from Monticello AM as its head of healthcare originations for seniors housing and healthcare bridge lending team. Leveraging her more than 20 years of experience and multiple cycles, she's involved in every stage of the origination process, and she's bringing that expertise to the panel today. Very grateful to have you on. Welcome, Karina.
Pleasure to be here. Thank you.
And Ann Wright joins us from BOK Financial, where she is a vice president and relationship manager focused on construction and acquisition bridge financings. She started as an underwriter there and has worked her way up, and it's great to have your insights on the panel. Welcome, Ann. And the way we have the conversation set up today is posing a series of scenarios that borrowers face today to our panelists, and they will lay out what really are the best options available to them, what terms and pricing borrowers can expect today. Maybe we'll see a little competitiveness come out among the panelists too. Wouldn't that be fun? And I also have some other general lending questions that I'll sprinkle kind of throughout the call. And listeners can also enter their questions in the Q&A box within the Zoom window, and we'll do our best to get to them. The webinar will run until 2:15 Eastern, so 75 minutes, which should give us enough time for everything. But if we don't have time for some of the audience questions, then apologies in advance. And if ever anyone has questions about the news and deal data that we provide at the Senior Care Investor and Levin Pro, you can always email me or click on the links in the slides here. I will provide them in the chat momentarily. And lastly, a survey will appear upon exiting the webinar, and we appreciate all of your responses, so thank you in advance. But without further ado, I just want to start with a couple of topical questions. And Kristen, I'll throw this one to you first, but then I want to hear from everyone else. The recent movement in interest rates as a result of the spiking oil prices were likely not part of most borrowers and lenders' belief a year ago that rates should continue a slow and steady decline in 2026. I won't ask you how to predict exactly what's going to happen with interest rates or even the war in the coming months. But I just want to know how your business and the business of your lenders has really been affected by this, if at all.
Sure, Ben. We continue to see a very steady stream of acquisition opportunities. We're extremely busy. I know lenders are also really busy. I know that just because we have deals out in the market and it's taking lenders longer time, longer to respond and longer to get us term sheets. They're just pretty much overwhelmed. And interest rates are, obviously a concern, but I think when you look at seniors in comparison to some of the other CRE that's available out there for investors, it really is very attractive. Our fundamentals are very strong. No one can deny that finally the graying of America has arrived, and really COVID and the interest rate hikes and the impact on new supply have have helped significantly to drive occupancy on existing assets. So I feel like an asset class that overall we're very healthy, and we continue again to see very strong deal activity on our end.
Mhm. Has anyone else, felt a direct effect of just spiking 10-year treasury rates? Charlie, you're muted.
Oh, sorry. Yeah, I would note that to your point, the fundamentals are great, and there's a lot of capital flowing into the space. So it's kind of a really interesting time in that cap rates I feel are compressing while interest rates are increasing. So it's obviously that's not the norm, but I think that just speaks to the fundamentals of the space. On a positive note, with respect to interest rates, spreads are really compressing. So I mean, you can look at the broader CMBS market, which I know isn't mostly active in seniors housing, but that they're at historic lows in terms of spreads, and that really is weaving into Fannie Freddie spreads, bank spreads, life companies are coming in. So there's a lot of capital coming in, which is offsetting some of the interest rate hikes and just where bonds are trading currently.
Yeah.
And in addition to what Charlie was saying, on the construction side, I feel like that we have actually started to see a little bit more construction activity finally, which is fantastic for the space. I think that interest rates going up, and if there are rate increases from the Fed, that may start to slow down or potentially pause again. But at this point, I think that there are a lot of general contractors that are out there relatively eating the cost if they're even seeing it yet. It takes some time for that to trickle down in the market. But like us, they've been on the sidelines for some period of time and they're hungry for activity. So if there's ability to get competitive, that is probably not exactly what is slowing down the construction costs or slowing down the capacity to do it. It's probably overall return and cost of capital for lending, which, as Charlie mentioned, I think the low spreads and highly competitive environment right now is certainly helping to offset.
I would agree with what Charlie and Kristen said as it relates to, the silver tsunami and the supply demand dynamic. I think as a lender, it gives us a lot of confidence in the long-term fundamentals of the sector. In many ways, the demand supply is becoming a stronger driver of the deal activity than short-term movements in rates. We're on pace to eclipse our record breaking in 2025 in just the first half of 2026. Borrowers are very active. There's a lot of capital being deployed. We have found that in uncertain environments, a lot more emphasis is placed on certainty of execution. And having been through multiple cycles, we've learned the importance of maintaining constant underwriting guidelines, reliable capital, and the ability to close transactions regardless of, market instability. And I think that's what's kept us top of mind for a lot of our borrowers.
Yeah. And Karina, have you noticed any kind of flood of capital just moving from other CRE sectors into seniors housing because of that demand?
Certainly. Multi, retail, hospitality, all of the above to some extent.
Yeah. And Shayna, is there a certain point that interest rates could rise to that would seriously disrupt the way you do business at Bloomfield?
Yeah, I mean, I think if we see really fast and sharp spikes, it gets disruptive to transaction volume, which is disruptive to lending. I think if there's small rise in SOFR, small decline in SOFR, it doesn't necessarily affect the fundamentals of senior housing. Nobody shopping for assisted living for their mom asks the marketer what SOFR is today. So I think that the fundamentals are really good. I mean, certainly the 10-year is worth tracking. And whenever you see a 10-year spike above 5, that's sort of a alarm signal for people. But I think we're kind of feel like we're in a pretty good place right now.
And I would mention, Ben, that, to be clear, that a lot of the deals, at least in the permanent market, are still debt service coverage constrained. So, they're needing to hit a certain coverage to hit, find the leverage. And that is, obviously while spreads are coming in and there is some movement there, it is putting some pressure on just borrowers trying to hit their leverage targets, just at least in the permanent market, just as there's been, wild swings, obviously, to your point on, since the war has begun and what's happening in the treasury market. So it's something that we look at daily and size daily, and there are some ways to rate lock early in underwriting processes, but it is something that obviously everybody is looking at, and they are, like I said, they're mostly coverage constrained comparative to LTV or whatnot.
And thankfully it's not like 2022 when interest rates really spiked and operations were not as strong as they are now.
Yeah, I think that's true. The rate bump, or excuse the monthly rental rate bumps have offset obviously a lot of NOIs are, we get obviously update sizings and spreads month over month, and it seems like, to everyone's point, the fundamentals are good, and we're seeing that in the financials.
Yeah. Well, let's move on to our first scenario. I'll take us through the basics, and then Kristen, I'll throw the first question to you. But we're looking at a value add acquisition. It's an assisted living memory care property, roughly a $10 million purchase price, located in the Southeast in a secondary market, according to Nick Map. The sponsor is relatively new to the space. They have 4 other communities, and the story behind this property is that it's just been mismanaged by a national operator, maybe not getting the love and focus that it really needs. It was 75% occupied. It was cash flow positive, but single digit margin can certainly improve upon that, and it was not covering debt service on day one. The buyer would be bringing in a regional operator with a strong track record in the space, should give that property some love. And the loan request, maximum leverage, and non-recourse. So, Kristen, I just want to kind of get into your head here. How would you and Blueprint just first approach running a debt process for this kind of deal?
So, I mean, I think regardless of the type of deal, the way that I always start is understanding the borrower's investment thesis and their structural asks. And then I layer on the deal profile on top of that, because I'm really, financing solution agnostic. I'm trying to find the best fit and the most optimal financing for the intersection of their investment thesis and the deal profile. In this case, when I look at this scenario, what I see is that you're not covering debt service coverage. I can tell you that we have had really no traction with regulated lenders, banks, going into storied deals that have sub 1.0 coverage. It's just not something that's in their strike zone. Also, that the sense that the purchase price is $10 million, so it's going to put your debt, at a fairly low amount. And so when I look at that and the fact that the borrower wants maximum leverage and non-recourse, I immediately go to we're in FinCo, right? A finance company or a private credit world. And that's how I would sort of think about, okay, this lands here. And then I'll talk to the customer about, this is what I see. This is why I see it. These are the things that you can expect with these types of lenders.
So who's getting a call on this panel?
Karina and Shayna.
Yeah. This is definitely one that would be a good fit for us. As a bridge lender, we are typically getting called when something needs to move really quickly or something isn't isn't performing quite right now and has a story behind it. And so the first thing that we're trying to look at is really the story and why is this asset distressed? Why is it 75% occupied when maybe the market's 90? And why hasn't it rebounded post-COVID? Who's the operator currently and who's coming in? And so obviously we all know how important the operators are, and that's really going to be the first thing that we look at when we try to get comfortable here. And so what we're really trying to understand is, who's the old operator, who's the new operator, and why is the person coming in the right fit? And so we could get comfortable with this one probably if we know that we have a good regional operator that's entering, that has good traction in the market, that knows the right executive director, has the right people to call to bring in a good on-site team and build up the marketing pipeline and referral network within their region. And we don't necessarily get spooked by sub 1.0 coverage now, as long as we can see a path to get to the coverage ratios that would allow us to get it to one of the permanent lenders here on this call.
And Karina, what questions would you also be asking the sponsor and the operator to suss out whether the turnaround opportunity is real?
Yeah, I would agree, first of all, with a lot of what Shayna said. We're going to look at this very similarly. I think from a structure perspective, we would probably, be funding an interest reserve out of our proceeds to make that work. But the most important thing is, who's the sponsor? Do they have a proven track record in the market? Who on their team is going to be responsible for replicating that success? Have the owner and operator worked together in the past? Is the operator co-investing? Are they properly incentivized? Those are some of the questions that we would right off the bat ask.
Are there any special questions that you ask that really tells you whether they're the real deal or not?
Well, I think we look at their current communities and the success they created there and how that was accomplished. Is there boots on the ground team? Are there enough people on the team? We'd look at the expenses. We do a good amount of pre-work up front on a deal to really truly understand it, so that if we are to issue a term sheet, we're following through. Certainty of execution is very important to our borrowers. So we're going to look at, all the market fundamentals, of course, like everyone else, but we're also going to maybe dig in a little bit more into the operations than somebody else would, to make sure that there is certainty of execution.
Well, let's say both of you are satisfied with the operator that they're bringing in and the sponsor's track record. What would the maximum leverage you'd be comfortable with giving this borrower?
For us, I think maximum leverage is not a hard and fast rule versus, what do we think about the specific deal and what value do we think the asset is worth, kind of relative to their purchase price. I would say generally somewhere around 70, 75%, and then can kind of plus or minus just depending on, how we feel what we think about their entry point and their potential stabilized value.
I think we'd be.
Karina yeah, go on.
I think we'd be right in that same range, given the scenario here.
And what would the range be for the interest rate?
We're probably going to be somewhere in the 300s over SOFR.
Okay.
Yeah, we're a little north of that. We're probably, a couple hundred basis points above that. And sometimes dealing with even messier situations than this one.
All right. And then Charlie, let's say the turnaround worked, and now it's time for a permanent refinance. What are my options as a borrower? And maybe what would you recommend if I want to capture the most value that I've created? And how would that value capture change my permanent refinance strategy?
Yeah, we're speaking with a lot of borrowers who just have that, whether it be deals coming out of fill up or just turnarounds that obviously the metrics and fundamentals are you're seeing that in NOI. So we're sizing deals on the trailing 1 month. They're going to need to probably have a trailing 3 month to get all the way through underwriting. But the permanent market, and that's generally, that could be permanent, could be a 5-year market. It could be a three-year market. That's more on a mini perm, but 5, 7, 10. I think most borrowers right now are keeping it relatively short leashed, but they're trying to hit that market quickly to just obviously because of the cost of capital. So your cost of capital in those markets is generally going to be a fixed rate. Depending upon treasuries, it's going to be have a spread of between 150 and maybe 175 basis points. So it's definitely, and that's, non-recourse, no covenants, basically just pay us and you're good to go. We'll obviously asset manage and track it. So that's, I think that is what's taking place. And we're actually seeing some deals come in through above budget. They're hitting their pro formas quickly. They're getting out. They're actually, while they're in some lockout periods with some debt funds and whatnot. So, which is great. We're able to take a look at those early, and they want to go to market, and that also could be a sale where it's a transaction. But that's obviously what's going on. Just lower that cost of capital and get to the permanent market as soon as possible for most borrowers.
And Charlie, can you lay out what the current competitive landscape is today among Fannie, Freddie, and the life cos, how they're competing with each other?
Yeah, I think that's important. Is that through the last several years, Fannie had been sitting on the sidelines, mostly in asset management mode. Freddie had been quoting, and which was great for liquidity in the space, but there wasn't a ton of competition, so spreads were wider. Life companies, there were a handful, not a lot. It wasn't widely, a widely lent community from the life company space. So it's competition, creating that competition. And I think where there is competition, because there have been new entrants from the life companies into the space, that has helped bring spreads down, get terms to be more borrower friendly, and obviously just more competition. So it's life companies and more life companies predominantly, where you're pushing on the leverage. It's been, Freddie's been able to do that more so than Fannie. But obviously, you're canvassing the market.
Well, speaking of leverage, we have an audience question. Are there any favorable deal parameters where you would lend close to 100% of the purchase price? And if so, what would you need to see?
We have done something similar to that, where we feel like the purchaser is getting a great deal. So if, for example, a deal that we did, we had a operator who was operating pursuant to a lease. He had added a ton of value and really improved the NOI, and had a lease purchase option. He was a small operator and really only had, he had a few properties in his portfolio, but didn't have a ton of equity to put in the deal and wanted to retain as much as possible. So we gave him nearly 100% loan to cost. We felt our loan to value was better, but nearly 100% proceeds in that scenario.
Got it. All right. Well, that anonymous attendee could reach out to you, perhaps.
Feel free.
I would agree with that. In a situation where somebody's exercising a favorable option and value creation is there, we could go well over 90%, all the way up to 100 if the deal makes sense.
All right. Well, reach out to Karina too. You guys can fight it out. All right. Well, let's move on to scenario 2. This is something that we've seen a lot more of in the last year and a half compared with all the years post-COVID, but it's a stabilized acquisition. It's a mix of independent living and assisted living. It's a little larger check. It's $24 million purchase price. It's in a secondary market in the West. It's an established sponsor. It's got more than 10 communities. And this was an off-market deal that they found from a mom and pop seller and a very attractive basis. It's got strong historical occupancy, limited new competition. It's strong going in loan metrics, and the buyer is retaining a strong regional operator. basically everything's going right for this deal. They're looking for the lowest rate, moderate leverage, and non-recourse. Kristen, can you just tell me what the competition would be like for a loan like this?
There are going to be a lot of lenders who come to the table for a deal like this. This is what I call kind of a middle of the fairway deal. And again, I go back to, what is the buyer's investment thesis as far as hold period and those types of things. But you would see everything from, regionals, strong regional banks, banks that we are strong contenders in our space, to life co and agencies circling a deal like this. And again, agencies a little more dependent on, they look to agency experience. But I do think there would be a lot of people duking it out to win this one. But I would like to ask, Anne and Shayna and Charlie, what do you guys think the best interest rate would be for this borrower while keeping the leverage moderate? And I'll pepper that in with, I know you'd probably have to have some recourse, but pretend for a minute you got that recourse.
I appreciate that. And like Karina was saying earlier, we tend to underwrite holistically. So we got to know exactly who is getting in the deal here. Do they have, ability to continue operating with past success, whether or not they have a wait list, things like that with secondary market. Is it at least primary market adjacent? Like what kind of does that look like? But assuming everything checks out, and yes, assuming that there's a guarantee, because we are a recourse-based lender, which if any time I talk today, it's always going to be recourse-based lending. I think that there's ability to size this one up, and this would kind of be a great example of what you guys were talking about previously, to potentially lever up on the acquisition as well. Usually it's being sold for a high price, especially right now in the market. So I think that with moderate leverage, so 65 to 75% or 65% loan to cost with ability to earn out, I think that you could get some strong rates. I would say if everything is perfect, you're probably getting low 200s for traditional regional banks for all the perfect processes in that deal. Stabilized debt right now is pretty competitive.
And would you be able to win that deal, you think, with that kind of pricing, or how do you compete for that really?
You're kind of spot on. There's a number of levers you can pull in terms of what is most important to the client. Is it maintaining the highest leverage? Is it getting the lowest rate? Is it finding the path to whatever it is that they want to do, whether it be a hold or sale or flexibility with prepayment. So there's a lot of different options that you could pull. If ultimately it comes down to pricing, that is a tough world. And I'm not sure that I would be able to confidently say I'm going to be able to drop pricing the absolute lowest to win it. If you want surety of execution, that's something that we could compete well in. It just depends on what's most important to the client and how well we can play to match what is important to them.
I think it goes back to what Kristen was saying earlier about, what her process is when she takes a deal to market. It's important to have a partner like Kristen and the Blueprint team that is really going to tell you as a lender, here's what's important. And there comes a point where I'm sure all of us get priced out. If it's only price, then you a fast no sometimes is just as valuable as, that rate. And so you say, thank you for the look. We appreciate, you showing this to us. We'll see you on the next one. But there may be a situation where the borrower is not as price sensitive and something else is more important. Maybe they're not open to providing recourse, right? And so that's where when you evaluate the deal to begin with, you kind of say, hey, what are my chances here? What does the competition look like? Is it even worth the time for us to compete here?
Yeah. So this one's for all of you, but what is the main hallmark of a deal that you would fight for? Is it that particular operator that you want to do more business with, or I guess simple question is what makes you fight for a deal?
I think, probably for all of us, you're looking at clients and borrowers who aren't just one-off transactions. Obviously those in large scale are great, but I know Kristen a lot of times you'll bring deals our way, and it'll be deal looks great, but what's the growth? What are the future opportunities? And then I think if you paint the picture that there's a lot of growth opportunities in terms of ongoing lending, building that relationship, and specific to KeyBank, if you're using multiple, you're not just utilizing the balance sheet, but you're also doing some permanent execution, or you might be doing some treasury or other banking services. That's the sweet spot. Specific to the permanent market, obviously the sweet spot is generally speaking the non-recourse fixed rate financing. But I think it's not just the one-off. It's those that you can paint that. So for any borrower to say, look, I've got this deal, but it's going to lead to a long-term relationship where we're going to be looking at other opportunities. I think that's critical.
And how much have you seen rates move just in the late stages of a competitive process, kind of anecdotally?
I mean, and it depends on where they're starting, right? Depends on if you're close to the ballpark to begin with or not. I would say, to Charlie's point, if you've got someone that is fantastic, you really want to get in with, or really got to get that next deal done, man, I've seen pricing move 15 to 30 bips. I've seen that come with also, though, potentially higher fees, or for example, with Charlie saying, if you're getting the back end and permanent financing, then you can drop even lower. I think the highest degree of competition always comes from, are you competing for a well-known sponsor, client, guarantor that you really like, or want to get in with? Is it at the right location that supports the project for long-term growth? Is it, if it's a secondary market, like I said earlier, is it primary market adjacent? Is it a hot spot for seniors that just tend to outbeat the rest of the United States in terms of demographic? Does the demographic also have the ability to grow with these rate increases? Or do you think you're going to get primed out? I mean, and for us, strength of guarantee is a strong basis for us. Of course, it is not your primary source of repayment, but both of those things have to check out for your first source and your backup. So long story short, I've seen pricing move 15, 30 bips plus, depends on where you're starting and why.
Yeah. Kristen, you've seen that too?
Yes, for sure, especially for deals with this profile that are stabilized. There's a lot of debt chasing these middle of the fairway deals, and things heat up as we start to form a market around a particular transaction. It gives me an idea of, again, what are the terms, what is most important to my customer, and where can I push? And there's always a trade-off between leverage and price, or spread, but at a moderate leverage deal, you can lean in. And if it's a strong sponsor operator combo, especially, that folks want to either continue to build a relationship with or get into the relationship, they will stretch.
Well, we got an audience question. How do you assess clinical operations, clinical risk, often a blind spot for lenders with surprise government action, increasing liability claims, and impacting business and community reputation? Karina, you want to try that one?
Sure, absolutely. So I think we see an incredible amount of data come through our platform, just on the opportunities we're reviewing, on situations where our partners may be asking us to chime in and do an assessment. And so what the Monticello team has done over the past couple of years is really build out our tech stack to track that data. And so we're looking to see, if we're presented with a deal in a certain market, we obviously are going to look at NIC data, et cetera. If it's skilled, we're going to look at CMS data. But also in our own opportunities, we reviewed over $25 billion in transactions last year. And that's just things that we pre-screened. That's already for, some non-starters weaned out. And so there's not a single decision that happens in a bubble. We have an incredible team. There is not a single term sheet that goes out that is not discussed and really well thought out. And we deploy that data.
I was going to mention it's obviously a very detailed, interesting, point that obviously clinical, we're bankers. We don't, it's hard to dig into the specifics, but there is a third party report that we often utilize. I know Fannie and Freddie require it. It's a regulatory assessment, management regulatory assessment. Typically, I think the survey company, Sissy Brockman and the survey companies are, one of the leading firms providing that. So we do dig in, and there is a third party report for that reason.
We have utilized those as well, third party, mock survey companies, et cetera, both when we're entering into a potential opportunity and on an ongoing basis, if necessary, in asset management.
And just to jump in too, some of it is, yes, having an expert team in-house beyond just this being what we do every day and understanding that, right? It's different to operate in California than Texas. It just comes with different governmental, it comes with different standards, it comes with different everything all the way from top to bottom. So I think first things first is having open discussions with your clients, right? Having that discussion with your operations and borrower. That's why you underwrite the entirety of a deal and get to know the character of all parties involved. It can be as simple as, a Google search too. Is there any pending lawsuits that we need to know about? Some of this is just having those conversations and understanding if there is a suit, is it for a frivolous reason? Like we saw so much of, frankly, post-COVID, or is it for a very concerning reason that we need to further investigate? Do they have any issues that are pending with their licensure, that kind of thing? And making sure you feel comfortable first and foremost. It also comes with background checks and credit checks and that kind of stuff. Like I said, character comes first, and understanding who you're working with is absolutely important, and making sure that you know what you're getting into, both from your location and having an expert team with that, but also with the character and making sure that they understand what they're working with. I'm not going to tell my client how to run their business, but I sure the heck want to feel comfortable with them running it, right?
Yeah. Good points. Well, I want one last question in the stabilized acquisition and just kind of stabilized Class A assets in general. Charlie, can you tell me how the permanent refinance market has changed for that subset of the market in the last year?
Yeah, I think to the point we were talking previously, spreads have come way in. I think where a year ago fixed rate spreads were, and mostly it's the fixed rate spreads that are coming in. We're pushing 200 now. They're in the 150s, and those are general, but that's just kind of so that has, and a lot of that is because of competition. There's been more lenders coming into the space. Like I said, there's some life companies who were, multifamily lenders, but they need to deploy capital, or they're having, there's challenges in other asset classes that where they're not deploying that capital, and seeing that, obviously, to our point, that finally the graying of America, that we've all been talking about for, it seems like several years, decades almost, is finally coming to fruition. So with the supply and demand dynamic, so obviously a lot more capital chasing deals, and I think they're seeing that in spread compression, and even pushing leverage a little bit, from maybe where it was 65, you're doing some 70% deals now in the permanent space, and going from there. So it's good to see.
Yeah. Well, what's also come back is the financing environment for portfolio deals that had certainly gone away for a couple of years, and now we're seeing a lot more portfolio deals being taken out to the market and financed. That's not just Welltower buying them anymore. But let's take a look at this scenario. It's 7 full continuum properties. It's a mix of stabilized and non-stabilized assets in multiple states. Several years ago, I don't think a portfolio like that would have even been taken to market, probably would have been chopped up. But the whole portfolio is being taken out. There is positive cash flow. It's a $180 million purchase price in different Midwest markets, both secondary and tertiary. It's an institutional fund with multiple operating partners taking groups of the properties, and they're requesting a mix of senior and mezzanine debt up to 80 to 85% total leverage. Kristen, how would you start this process?
Again, I always start with what are the borrower's objectives and how do I best match the financing with their investment thesis. I mean, these types of deals are really fun as a former lender because you get to, it's like a puzzle, right? So what's the best way to put the pieces together? One of the things that, we would do is we would size the whole portfolio and then, cue in on each individual asset. Secondary is a very different proposition than a tertiary market. But I would also want to understand, the size of this is compelling from a lending standpoint. But what is how much are the unstabilized assets dragging down the stabilized ones? So does it make sense to, do a larger cross-collateralized portfolio, cross-defaulted portfolio, or is that going to be too much of a penalty to the stronger assets? So do you chop it up? And you really have to think about it. Obviously your debt for your non-stabilized assets is going to be more expensive. So you sort of have to look at it through a host of different lenses and figure out, generally what do you think is the best alternative? Plus you've got this mezz component on it. What does that look like? How much could the non-stabilized assets bear overall? So this one is you have to really get in there and dig and what are the size of the assets? What are the ages of the assets? All of those things are super important as well.
And who do you think would be interested in doing the senior loan? Like what types of debt funds or banks?
Well, I think that's a little bit of a loaded question that you have. Is it a large pooled crossed, portfolio where there's enough, you're drafting off the stabilized assets enough that the non-stabilized are supported, that's a credit supportment to the non-stabilized, or are they too detrimental to the overall metrics? When you start to get, very thin to 1.0 sub, coverage, now you're in the world of debt funds. But a regional bank, right, especially if there was some guarantees, which we don't talk about here, and it was in their farm area, could be very interested in this transaction. Again, assuming it's one larger deal, or you could harvest out the more stabilized assets and take the others and look at maybe more of a private credit play.
And you would agree?
Yes, very much so. I actually did a deal similar to this within the last 6 to 12 months here. So the difference being it was, one operator, one guarantor, one holistic sponsor in this situation, the strong guarantee. And we actually just took out the mezz part and did the whole thing. And the kicker is exactly what Kristen is talking about, is if the assets that are not stabilized are in the right types of markets, how old are they? Really, why are they not stabilized? And do we believe that they can get there? If those things all check, yes, absolutely 100% interested in doing this with the right folks in the right locations.
Would you be scared off by there being multiple operating partners?
Not necessarily. It depends on why. So for example, if you've got multiple locations and you're in, like I mentioned earlier, a Texas, a California, maybe a DC or a Boston, those are going to require different expertise and you want the right partners to be in those deals. I think if every single project had a different operator, you've got different ideas that you've got to work past. It doesn't necessarily mean no. It could be a strength to the deal actually, but it also just depends on the rationale behind why there are so many operators.
And it's funny you mentioned that thing about the mezz. I was even going to ask, does this deal get done with the mezz? Or do you think a senior lender would just come and want to do it all? But if there was a mezz lender, I guess, Kristen, could you just kind of lay out the options? Who would be out there willing to do the mezz debt, and what kind of pricing do you think a borrower could expect to see?
I think mezz is pricing in I think around, 12 to 14-ish% roughly today. It's driven by the size of the mezz, so that a lot of the debt funds will also play in the mezz space. In fact, some of them, prefer to do mezz over like a pref slug or something of that nature, but it's very much driven by the size. So the smaller the check size gets on the mezz, the harder it is to plug it. A lot of when you think of private credit, you have to remember there's a lot of bigger PE firms that play in the space, and they really don't want to be bothered unless they can write larger checks. It's not really worth the investment of their time. So that's kind of the scenario there. And I agree with Anne that likely you wouldn't need to layer in mezz debt. You could probably figure this out. And maybe, depending on the cost of your equity, maybe what you do is you build in a performance-based earnout so that you're not advancing quite so much out of the gate. But it's that trade-off of mezz versus what your equity cost, and then what are all the tentacles that come with the mezz. And not all senior lenders love mezz either. So.
Mm-hmm. And Charlie, for a portfolio, just in general, when do you think we should start having conversations about a refinance?
Yeah, we for those types of transactions, we typically, the takeout is a minimum portfolio of 85% occupancy. So once it starts ramping into that range, we start really kind of digging in on a month by month basis and trying to tee it up and size for proceeds. And is there a takeout? A lot of I think we're more conditioned to partnering with mezz on our balance sheet lending in this skilled nursing space that can, because with a HUD takeout, because they're able to push the leverage a little bit higher, which is the mezz can't survive a Fannie Freddie life company takeout. Typically, some life companies will permit it, but so you really just have to size it. Is the NOI where it needs to be to capture the full refi? But we do that as soon as we can, obviously because of the capital costs and really trying to get to that permanent non-recourse market.
Got it. Well, we have an audience question. How does asset age affect underwriting? Impact on loan proceeds, rate, guarantee, i.e. a 30-year-old building versus a 15-year-old versus a 5-year-old. Shana, do you want to take that first?
Sure. Yeah, I mean, I think everyone prefers the newer buildings to the older buildings. I don't think that's a secret. But I think a lot of these older buildings are sort of overlooked and can be a good fit for lenders. A lot of our borrowers are buying older vintage buildings, renovating them, and putting some love in so they can be a solid B+ asset. I think that the reality is a 90s vintage building, people sometimes will have hard cutoffs, but a 90s vintage building that's been renovated and well maintained can position itself nicely in a market. So I kind of like them.
Okay. And then is there a certain age that you hear and just prejudice, you think, oh, that's an old building? I guess what's the cutoff at this point?
I think anything over 25 years now, people are looking at as an old building, and that's sort of the cutoff. But I think it comes down to maintenance and physical layout. I mean, if somebody built a brand new building but did all small studios, and it wasn't built by a senior housing developer and it was poorly laid out, that's almost worse than a purpose-built 1995 vintage building that has a good mix of studios, 1 bedrooms, and 2 bedrooms. So I think it's, we try to look at it with a little more nuance, I guess.
Also, what does the competition look like in the market, right? If it's a Class A asset, but there's another one a mile down the road, right? And they're getting a certain amount of rent versus you have a more middle market type of product that's, there's no competition in the area. You might prefer that older vintage middle market product.
Yeah, good point. All right, well, let's move on to our fourth scenario, this is a value add deal, but they are looking to do a large kind of CapEx project and get that financed as well. It's a full continuum property. They're buying it for $43 million. It's in a primary Western market. And again, it's an established sponsor. They've got more than 10 communities in their portfolio. It's an older community. It's got a lot of deferred maintenance, outdated units, common areas, that not one of those bells of the ball that Shana described too. It's only 75% occupied. It is cash flowing. It's got a decent margin, could definitely get better with a refresh. And the buyers bring in a new operator to do that. And all the units are going to get upgraded. To do both the acquisition and this CapEx component, they're looking for non-recourse debt and trying to get obviously the lowest rate that they can at moderate leverage in the simplest structure. So Kristen, the sponsor, wants all these things. Which of those four objectives, I guess, are reasonably achievable together? And which one would you maybe ask the borrower, you got to compromise on this one?
So I think the non-recourse moderate leverage is goes hand in hand. Rate and recourse are always a trade-off, right? So you're always going to pay more if you don't, or not always, but 90% of the time, it's going to be a more expensive loan if there's no recourse associated with it. And so I think actually the hardest thing is to provide a simple structure for a deal like this, because you have a lot going on. I mean, my guess is this is a deal that, you're going to need a CapEx holdback. It'll probably have to be tranched depending on what they're doing and, what level of, is it FF&E? Is it, major mechanical? You're going to need some draw requests and construction maintenance possibly. And then the other point here, if this is roughly 75% occupied, they're probably going to want a performance-based earnout. So there are going to be some structural bells and whistles around this type of loan. So it's the simplest structure. I don't think there is probably a simple structure for this type of transaction unless someone just has a credit line that gives them, kind of free will to draw for these types of things. But large CapEx, generally you want to have some checks and balances there.
Yeah. Shana, what questions would you have for Kristen if she brought this opportunity to you, and who's winning this deal?
Yeah, the first question I'd really want to understand is what's the CapEx plan? What's been priced out to date? Who is going to be the operator, and who's going to manage the construction? So we've done deals like this that had major renovations associated with them. We like to know, who is really going to be overseeing that construction project, because as I think we all know, construction can get away from you quickly. Is their budget sort of rough guesses, or have they walked the building with contractors and have their budget, I don't want to say fully baked, because sometimes it's hard to fully bake a budget until you've actually owned the building for some time, but is it as close to fully baked as it can be? How did also in the deferred maintenance, what exactly is, do we have water damage and mold? Those become a lot trickier and they can spread and you can find surprises. Do we need to just do a cosmetic refresh for a building that just looks long in the tooth? So really getting to the bottom of the whole plan. And then ultimately the next question would be, what does their pro forma look like after they complete the renovations? And really, where do they expect to price their rents relative to maybe some of the newer vintage assets? So, an old building that's been renovated, generally speaking, is going to be at a discount to a brand new building. And that might work within the pro forma, given the purchase price. I mean, it often does. We like those situations a lot. But if you need to get if you're pricing at the same rents as the Class A building, it becomes a lot trickier. So those are the kinds of things we'd ask Kristen and try to dive into.
And for a situation like this, or just any value add business plan, at what point does one of those deals or business plans just get too heavy for traditional bank execution?
Shana touched on a lot of this. I think a big portion of it is what is involved in the CapEx. Is it major repositioning, cosmetic versus material? Are you doing paint, or are you doing structural unit changes? Are you requiring the current occupancy you have, or occupants, would they need to move out for you guys to need to do this? So your cash flow is now interrupted. And that kind of leads into the next thing. If you have limited cash flow, operation deficiencies, you have significant runway that you need before you get ever to covering debt service, that's probably not something that feels really warm and cozy to your lenders, even if you have a super strong guarantee. And then the other things would be probably a total reputational rebrand in the market. That is pretty difficult to overcome from time to time, and could scare off some lenders, and or indication of low market occupancy. So if your occupancy has to go down to move all of these folks in after you guys complete these renovations, are you going to be able to fill that building back up, or is it oversupplied in the market, and having an older asset even being renovated, you're not going to achieve the rents or the imbalance that you guys need to because of the market demands?
Is this something BOK would do, or it kind of too much work involved maybe?
The answer is it depends. For all things, it depends. It depends on the strength of recourse. It depends on who's coming in and what their story is with it. Are they acquiring this building to build out their web, and they know this building intimately, and it's easy fixes and cash flow, and you get there and it plays well into what they're already building and we know them? Or is it some of those things that we just outlined? That there's a lot of factors that would play into this, but if everything kind of checked out, it could be something that we'd be interested in for recourse, and assuming all the stars aligned.
Yeah. And Kristen, what kind of pricing would the borrower be expecting with that CapEx component, as opposed to just a traditional value add acquisition financing?
I think it's really just, I don't know that the CapEx is that much of a driver as the whole. It's a value add opportunity. I would say we're seeing deals where there's a value add component. I think 275 plus, and again, if it's truly a non-recourse loan, this could inch up a little bit closer to the threes. It's really going to depend. Is this going to fall in a bank bucket, or are you going to be more of a FinCo private credit bucket? And again, I mean, that non-recourse and rate kind of always run contrary to each other. So
yeah. Karina, if you're sizing this deal, are you sizing it to the acquisition cost, to the stabilized value, to in-place NOI, or some combination of that?
I think all of the above, really, Ben. I think first and foremost, all of us said on this call, the sponsor, that's first and foremost. We're very much a relationship lender. 84% of our business is repeat business. And so that's always going to come first. But, we're going to look at day one, we're going to look at the loan to cost, in place debt yield, to determine, what attachment point we're really comfortable with, what reserves need to be in place, if any. We consistently, in our deal, structure in earnouts along the way to maximize proceeds for the client as they execute their business plan. We're not just going to look at one thing in the vacuum. We're going to, analyze the entire scenario holistically. Submarket demographics, competition, market rents, any other factors that would impact the feasibility of the sponsor's business plan, as Anna and Shana both said. I think all those are very important.
And Shana, let's say things don't go perfectly and lease up takes longer than expected, and maybe I get a stern phone call from you, but as the borrower, how much flexibility would exist around covenants, extension options, and the performance hurdles?
Yeah, I mean, I think a lot of that is, it depends why we're behind. Did we have a surprise in construction, and we found something that needed to get remediated, and it took a little bit longer, but now the problem's been solved? I mean, okay, a little bit more time is fine. Did we Did we get the building open? We hired the wrong executive director and we realized we had to make a change. And, we made a change and now everything's back on track. Okay, fine. I can buy the story. If there's just problem after problem after problem that don't seem to be getting solved, I mean, at a certain point, we'll lose patience. So a lot of it comes down to the story, and we do try to work with our borrowers and our operators to make sure we can figure out something that works for everybody and keep everyone on track. So, and we really do try to get in deep dive into the business and ops to come up with a good solution.
All right, good. I'm glad we can work something out. Well, we got 15 minutes left. Just a reminder to the audience, I did post the slides in the chat, so you all have access to those. But I want to wrap up with a new development scenario. They're certainly still happening, and they're certainly coming in the next couple of years. And I want to direct this first opportunity to you at BOK. We working on a full continuum project, very a la mode these days. It's $80 million development. It's in one of the top 50 MSAs I'm working with. I'm the experienced developer, but I'm new to seniors housing. I've got an operator that's aligned with money in the deal, their experience in the space, and I'm just curious, what kind of term can I expect? What kind of leverage should I be asking for, and that I can likely get? What kind of pricing can I expect? And then just as far as recourse burn-offs, what can I expect there too?
Yeah, this is almost a fairway deal, with your kicker being the developer not having done senior housing. Senior housing development is different than a multifamily because there's so much that you have to play into and think about with all of the requirements per government and municipality to get things done. So the question is, maybe the developer is new to senior housing, but the development team is not. It could just be a new developer. And you might have an incredibly experienced senior housing team on the background. And if that's the case, then I derive a great deal of comfort from that, as well as having the experienced operator that knows exactly what they're doing, strong guarantor, strong equity group, and all of that. So if those are the cases, then yeah, we're interested in this. But it is to proceed with caution, of course. I think that a fairway deal on this is, a 60-month term, maybe a 1 or 2 year extension options, depending on what they're looking for. Probably initial term close to 48 months IO, and then start amortizing thereafter, give them some time to complete construction, get leased up. I would say your leverage is going to be more moderate for this one. I'm probably looking 60, maybe 65 if everything really checks out. And like I said, you gotta have, we've all harped on this, you've got to have the right location, the right operator, right sponsor. Everything's got to make sense for what product you're building and the place that you're building. And if all of that is fantastic and everything tracks, it's going to come down to, like we were talking about, how bad do you want to get this deal done and how perfect is the deal for what you're doing. So pricing, I think, for construction, if it's a primary MSA, has come down with the perfect national sponsor, super strong guarantee. You could get 250 or sub, depending on what you've got going on there and everything else checking out. And then typically we structure in burn downs on that rate at CO or licensure, and then again, or at a 1.0 debt service coverage, and then again at a more stabilized debt service coverage. And those burn downs could be 15 bips each. Usually it's a much bigger burn down for your stabilized debt service coverage ratio. And then same thing with recourse. We always need 100% completion. Projects got to get built. You need carrying carve outs through the duration of the loan. You're probably looking at a repayment guarantee, though, starting at 50 through construction. And then once you get CO and license, your risk significantly decreases. So we typically burn down to somewhere about 35. And then like the rate, you also have a percent burn down to somewhere around 25% at a more stabilized debt service coverage. So that would be our typical or fairway structure for something like this.
Yeah. Well, I may be new to the industry as the developer, but that was certainly education. So, all right, great. It's a great option. Kristen, Anne touched on this, but what is it about a developer being new to the industry that affects the types of lenders that would be willing to work with them?
I mean, I think you've heard it echoed throughout this call. The operator and and the sponsor are key to the deal. And those of us who've lived through cycles have seen tourist investors in the space who don't really understand the differences between, let's say, multifamily and seniors housing. It's not that you could not get that deal placed, but I think you need to compare it with an operator who is experienced not only in the space, but also in doing ground up, and they've probably worked with the developer through the design process to make sure that this is a building that's actually going to be palatable for seniors. And then the other, types of things are like, is this operator experienced in this particular market? I think that, that helps shore up the story. And then, as Anne mentioned, like what types of leverage is the borrower looking for? If it's lower and more conservative, that helps the case. What kind of credit enhancements are they going to offer? And Anne touched on this, like, does it make sense? Does this project make sense for this market? And, where is your ultimate PPU, price per unit, landing? Do you feel comfortable that you have exit runway at that kind of build cost?
And Charlie, how would you approach a refinance strategy for a development like this? And what's a rough timeline for that?
Yeah, similar to probably what I mentioned earlier, there, coming out of the lease up, you're probably looking at 85% ish, just to start the permanent discussions. We sized before then, but that's typically kind of where they're going to size on in place NOI, can size to a T1, but you're going to need to see that through, a couple months as you get through the financing. So, there hasn't been as many construction loans, coming out of lease up, just given where we are in the cycle, but I think that will start to ramp up in the coming years. So that's obviously newer product. It's, I know the cap rates on those, we're seeing a lot of newer deals that are stabilized now coming to market. Kristen, I know you guys are brokering a lot of those, and it is amazing the cap rates for some of those deals that are getting done in the market right now. So obviously it's a very attractive, policy there.
Well, speaking of the falling cap rates, the rising per unit costs, prices, Shana and Karina, I just want to know from you, what do you need to see in the market to greenlight more construction loans going forward? If you're interested in construction at all, is it seeing higher per unit prices in the markets that a construction project is going to happen? Is it certain cap rates? Is it lowering overall borrowing costs? Is it construction costs? Like, is there something that you need to see to greenlight more construction loans?
We're candidly not doing ground up construction at the moment, but that can change if we're shown, proof of concept from a sponsor that we've historically done business with and is strong in the market.
Yeah, that's the same for us too.
All right, Kristen, what have you heard?
We'll send them all to Anne.
I was going to say, yeah, what I need is more construction loans to greenlight more construction loans. I need more construction opportunities. I do think that it's coming down to lower construction costs. I think that that's frankly what is preventing there being exactly that, more construction opportunities. I think some folks are still waiting for just that last little step to make the capital investment make sense and the cost of capital stack really prove out. But those lower interest rates, as we started the call with, are certainly helping. So we just need more of them to greenlight more of them.
And to Anne's point, Ben, it really is like I've seen the market more, the new development market constrained from the equity side, really more than the debt side. And I think a lot of the equity, certainly COVID and then with the interest rates hikes, have been interested in picking up assets that are newer, maybe failed to thrive during COVID, that they feel like they're getting below replacement costs. But I can tell you that the early stage investors are circling, and I know several handfuls at this point of institutional capital that are well-seasoned players in our space that have had their first and second and third development deal approved. So it's definitely coming, and it's also by the virtue of the competition of all these firms that are circling around these core plus core deals. And unfortunately, if you're private equity and a levered borrower or a levered buyer, it's very hard to compete with any of the REITs who show up and want a deal. So they're starting to figure out pretty quickly that to deploy, they're probably going to have to pivot to development here in the very near future.
Yep, I know, and just with the extended timeline of, well, then you have to get shovels in the ground, you have to open it, you have to lease it up. That's a long timeline. So it's the good work that Anne is doing. There's still supply coming on online, but
that's right.
A lot more will have to get done. We got an audience question. As a new analyst, I've read about the large maturity wall coming in 2027, especially for loans that were extended during the higher rate period. From the panel's perspective, are there any key indicators that should be followed to understand how that refinancing risk will likely play out within seniors housing? Christian or Charlie, you want to take that first?
I think Charlie, that's a great one for you, and I'll follow on.
I know that it's definitely being tracked in terms of, that's right. There's in terms of the maturities, which makes sense if you think of, there was a lot of consolidation, in the 2016, 17, 18 year time frame. So if those were 10-year deals, those are coming due. Even into 28, 29. So I know it's on everyone's radar. I think there will be some large, and we're seeing that now. I think the last couple of years it's just been some one-offs. For in terms of predominantly for stabilized financing. There's been more portfolios that have come to market. A lot of them have been the Class A's, which have just been amazing. Like I said, the cap rates that are in the low fives right now. But it'll be interesting because these will be older product just from the standpoint of their, they've been, financed probably for 10 years. And they, to get to that. So they're probably, 15, 20-year-old properties at minimum. And to kind of your question earlier, there will be a financing mechanism for those. And I think everybody's looking forward to that just to drive some volume. Fannie and Freddie especially is, their volumes year over year have been increasing, and it's where they want to put capital out. So Fannie is coming on a little bit more, just as they get through some of their portfolio issues, and there's life coming. So I think there will be more capital coming in and providing liquidity to the market. So HUD has there's been some conversations that HUD might be able to do more in the senior space, but I think that's they might do some one-off assisted living deals here and there, but that's probably not going to. That's going to be more towards the skilled nursing sector. And by the way, Ben, congrats on your interview with Frank Cassidy. That was great to see, and a nice interview. So got him good timing.
Thank you, Charlie. Yeah, should have brought him on for a quick recap of his tenure here, but we had a lot to cover today, so maybe next time. But thank you. A quick audience question for Anne, and then I want to wrap it up with a quick speed round. Anne, is there a particular area or region where you're seeing more ground up development?
The short answer is not necessarily, but you always tend to see more construction on either coastal states, as well as just sprinkled throughout your sunshine states and the Midwest. So not necessarily a lot of the projects now are just projects that folks would have loved to have done 2 or 3 years ago and have been sitting on them and waiting to get them done.
All right. Well, last question, quick 20-second answers maybe each, but if you're picturing our audience as all potential borrowers wanting to do business with you, what is a type of transaction that you want to do more of in the next 6 to 12 months that maybe could pique their interest? Anne, you want to start?
Construction, shocker.
Anne has made that clear. Well, great. Shayna, you want to go next?
Yeah, I mean, we love deals that need to go quickly. We are doing everything on balance sheets, so we often don't require appraisals. We can move really fast and we can get something done in less than 30 days. So that's a great deal for us. And then something that's a little hairier, has a distress story, and can be repositioned. We can get comfortable with a story like that.
All right, great. Karina?
We love the options, the favorable options we all talked about earlier at higher leverage point. We've done several of those. That's sort of been our niche with, regional growing operators that are really boots on the ground in their buildings. So would love to see more of those.
Charlie?
I would say just any, clients that have various touch points and need different banking services. I mean, it's relationship business, and we're doing a lot with institutional buyers and borrowers, even at the fund level. But they're, that's weaving down to the project level. So if you're having different touch points, it's obviously, attractive to, relationship banking.
Great. And Kristen?
We like all kinds of deals. Again,
Everything.
we like it all. We're helping, people place all different kinds of profiles of deals with all different types of lenders. So we like to look at it all. It's always a fun puzzle. I know we focused on debt here, but one of the things I really love to do too is talk to people about equity and programmatic equity and things of that nature as well.
Yeah. Well, fantastic. That was a miracle. 75 minutes. We got through every single question, pretty much all of our audience questions also, and that quick improv speed round. So you all are professionals. That was a great webinar, great discussion. I think our audience got a lot out of it too. They all got the slides as well. The survey is going to appear as soon as everyone exits out from the webinar. And a big thank you to Blueprint, who sponsored today's webinar too. It's always great working with them. And Kristen, thank you so much for all of your work putting together this star-studded panel, all the scenarios. It was a big help and ended up being a great discussion. So thank you so much, Charlie, Karina, Shayna, and great discussion. Hopefully we can do it again.
Absolutely. Thanks, Ben. We really appreciate it.
Yeah, thanks for having us.
Thanks, Ben.
Thanks so much, everyone.